Japan's public debt has always been known to be amongst the world's largest. Here's a graph with data from the International Monetary Fund. Here you can see that Japan's public debt as of the past few years has hovered at more than 250% of its gross domestic product. What that basically means is that Japan's annual economic output varies by year. But in 2023, it was over $4.2 trillion, which means that the public debt of Japan would stand at over $10.5 trillion. That's an insanely high number. Even though it's not the world's largest, as the one that holds that title is of course the United States, which has a debt to GDP of only 121%. But in real value, that's over $36 trillion, according to the debt clock. But even though Japan's debt is much lower than the United States, what matters more is the fact that Japan's debt is more than double their annual economic output. The goods and services that go around Japan's millions of people are not as big as the country's overall debt. But here's the thing. Even though Japan's debt to GDP is amongst the world's highest, nothing bad has actually happened. The economy of Japan continues to grow. Indeed, even though the debt is at a level that some economists might find unacceptable, Japan's annual GDP growth is still positive. Here's a graph for that matter, data from the World Bank. Here you can see that Japan's GDP continues to grow. Of course, it's not a big growth like the ones seen in emerging economies, but it still shows that Japan is still stable. It's not collapsing, neither is its government declaring bankruptcy. And that's what we want to question in today's video: whether Japan can actually borrow money infinitely. It may not really make sense. For an individual person, or even a businessman, you can't borrow money infinitely. You have to eventually repay that debt. So, let's try to find these all out. Before we try to understand whether Japan can borrow infinitely, it is first important to understand what led to this rise in government debt. The rise in Japan's government debt can be traced back to the asset bubble in the early 1990s. That asset bubble was a disastrous moment as it led housing prices, as well as the entire Japanese stock market, to explode in value. When people saw that this wasn't sustainable anymore, it led to one of history's biggest asset collapses. Here's a graph on the market capitalization of listed domestic companies. Here you can see that in the years following 1989, there was a surge in value for domestic listed companies in Japan. In 1980, the total value of these companies was just worth $379 billion. But 9 years later, it rose to a massive $4.26 trillion. That's a substantial increase. But unfortunately, if we extend this graph to just 3 years later, in 1992, we get to see that the value collapsed to nearly half, to just $2.25 trillion. The collapse, however, didn't go down back to hundreds of billions. It continued trading at a value of trillions. Nevertheless, this showcases a part of the asset bubble burst of Japan. Now, here's where it led to a rise in government debt. It starts with the fact that when the bubble bursted, Japan's economy had entered what is now known as the lost decade. What this simply meant was that businesses stopped growing, consumer spending was slowing down, and deflation became a persistent problem. So, due to a slowdown in the economy and a banking crisis that was happening at that time due to the asset bubble, Japan's government wanted to rescue the economy. They wanted to put everything back on track. They wanted growth again. They wanted to see businesses flourishing and people spending. And one of the biggest initiatives that they can do is to push out stimulus in the form of fiscal policies. What this simply meant was that the government started spending a lot of money to boost the economy. They invested in infrastructure projects, bailed out struggling banks, and provided financial support to businesses. That is one of the reasons why Japan's infrastructure system is one of the world's best, as the Japanese government has tried to rescue the economy through infrastructure investments. As a matter of fact, here's a graph with data from the OECD on infrastructure rail investment in 1995. Here, you can see that Japan's rail investment in that year alone had surpassed many of other major economies. Japan had spent a whopping 8.4 billion euros, whereas the United States had only spent 4.5 billion euros, despite being a larger economy. 1995 was also the very same year where Japan had been facing its asset bubble, and the year where the government had pumped out stimulus. But here's the problem with these fiscal stimulus. It's the fact that to do this, they needed money. A government's main way to generate money is no other than taxes. But at that time, tax revenues were going down. The Japanese government had been reducing corporate tax rates, which, as you can see in the graph, Japan's corporate tax rate once stood at more than 52.4% in the early 1990s, but by 2000, it shrunk to just 42%. On top of lower corporate tax rates, the country was also going through deflation, which affected tax revenues. Here's a graph on the total tax revenues of Japan's general government, data from the OECD. Here you can see that from 1990 to 2003, total tax revenues didn't really go up. In fact, it went down by 3 trillion yen. As a matter of fact, it's even worse if we take a look at the general account tax revenue as published by Japan's Ministry of Finance. Here, you can see that in 1990, general account tax revenue stood at 60.1 trillion yen, but by 2005, it fell to 49.1 trillion yen. Now, as we just mentioned, Japan stimulated their economy, and they did it by spending a lot of money, and with no tax revenues coming in, where are they going to get the money? Well, that's right. They borrow them. In Japan's case, they issue bonds. Here's data for Japan's total outstanding bonds. These bonds are basically the borrowings of Japan's government. It is what is reflected in Japan's massive public debt. And as you can see, it has grown massively. That is all because Japan's government wanted to stimulate their economy. But as many people already know, despite their heavy borrowings, the economy stayed sluggish. So as we go forward into the future, there's a chance that we may see Japan's debt to continue rising. There are plans to reduce it. But for entertainment purposes, let's just assume that Japan did borrow more. What would be the risk then? Or will there even be any risk at all? As it stands today, Japan's debt is very, very big. Yet, as you can clearly see, Japan's economy is still stable. As a matter of fact, many articles have even been reporting that Japan's economy is coming back. Its stock market is back up, inflation has returned, and overall, economic growth. All of these are happening despite having substantial debt. So, can Japan continue to thrive in this economic environment of endlessly borrowing money? Well, here's the interesting feat about Japan's debt. It's the fact that it's borrowed domestically, and repayment for Japan's debt is very, very small. Let's first start with how it is borrowed domestically. Japan's debt, when we mean it's borrowed domestically, it means that Japan does not owe this money to foreign lenders, like for instance, the United States. It, on the other hand, lends this money heavily into Japanese banks, corporations, insurance companies, and even individual Japanese investors. Here's a breakdown of the Japanese government bondholders as of September 2024, data from the Ministry of Finance. Here you can see that 569 trillion yen is held by the country's own central bank, and the rest is spread across various domestic institutions. Only 6.5% of this are held by foreigners. Now, this is a major reason why Japan's debt hasn't caused a problem at all, and a reason why they may be able to borrow more is because most of their debt is owed to themselves. When a government borrows from its own people and institutions, It's a lot less risky compared to borrowing from foreign countries. Why? Because domestic lenders are less likely to panic and demand their money back all at once. This creates a stable environment where Japan can continue to manage its debt without facing sudden financial crises. Secondly, when these bonds are issued, they are at a lower rate. Very, very low rate. That's all because of Japan's interest rate. The Central Bank of Japan, known as Bank of Japan, has set the interest rate of Japan close to 0%. This means the government doesn't have to pay much interest on its debt, making it cheap to borrow more. Imagine having a huge credit card debt, but with almost no interest. Your payments stay manageable even if the debt is large. Here's a graph on the interest payments of Japan. Here you can see that interest payments were stable, and going into the early 2000s, it even fell. So, despite the fact that in these very years we saw a surge in government bonds, the repayments had actually fallen. So, of course, in theory, if Japan's government continues to borrow money through bonds, but the interest rates stays low like these, or if it goes lower, then yes, Japan can actually borrow money infinitely. But when we say yes, it's highly debatable, especially amongst economists. There's a theory called the Modern Monetary Theory, MMT, which suggests that countries that control their own currency, like Japan, can technically borrow and spend as much as they need without worrying about running out of money. This is because they can always print more currency to pay off debt. That's what Japan has done over the past decades. But there's always a risk to these excessive money borrowings and printings, and that is inflation. If inflation goes up, and it did in Japan's case in the past recent years, then the fact that Japan's excessive borrowings can change. But anyway, do let us know what you think. Thanks for watching.